Welcome to The Explainer. Okay, we are diving right into the ultimate index fund showdown today. If you've ever had someone practically swear to you that their favorite index fund is the absolute only one worth owning, and you just sit there staring at your screen, completely paralyzed by all the choices, well, you're in the right place. Today, we're going to settle this debate using actual math instead of just, going off vibes.
We're going to track three very different investors to see how this plays out. But right off the bat, I've got to introduce a huge psychological plot twist. The ultimate winner of this decades-long financial race, it actually won't be decided by the ticker symbol they choose. Not at all. It's going to be decided by which one of them panics first. Because honestly, the most expensive mistakes in investing, they never really hurt on day one. They sneak up on you in year 11.
So let's start from the very beginning. Act 1. The $10,000 race.
Picture this. We've got Angel, Quinn, and Theo. They're exactly the same age, they earn the exact same salary, and they each decide to invest $10,000 on the exact same afternoon. Angel goes with Vanguard's S&P 500 fund. She's essentially buying a tiny sliver of the whole American economy for a microscopic $3 annual fee. We'll call her strategy the market. Then there's Quinn. Quinn buys the NASDAQ 100, which leans incredibly hard into big tech. We're talking NVIDIA, Apple, Microsoft, the whole shebang. It costs him a little bit more, about a 0.18% fee, and we'll call his fund the bet. Finally, Theo. He buys a dividend fund filled with super boring companies, banks and toothpaste manufacturers. It pays him about 3.3% a year in actual cash, which on 10 grand is roughly $330. We'll call Theo's strategy the checks.
Now, fast forward a few years. Quinn's tech fund is just running incredibly hot. I mean, at group dinners, he's bragging. He's pulling out charts on his phone. If we look at the last decade, his fund didn't just do the historical 12% average, it grew closer to 22% a year. And if you take that 22% return and stretch it across 30 years using a little back of the napkin math, that original 10 grand projects out to a seductive, totally intoxicating $3.7 million. I mean, it is so easy to see why someone would just empty their savings into tech after seeing a number like that. But here's the thing, that brilliantly illustrates a lie. Not because the arithmetic is wrong, but because literally no fund on Earth compounds at 22% for 3 decades straight. That rate is a recent hot streak. It's not a law of physics. Actually, if we reach back just one bad chapter to the dot-com crash, a similar tech fund fell more than 80% and took over 15 agonizing years just to return to the number it started with. Not to get rich, mind you, just to get back to zero.
Which brings us right into Act 2, the 3 a.m. event.
Okay, so by year 10, Quinn is winning big on paper. His 10 grand has grown to about $30,000. He's feeling great. But then the market does what it inevitably always does. It falls. A completely ordinary tech pullback knocks his fund down by 35%. Quinn wakes up to find his $30,000 has suddenly become $19,500 in a matter of weeks. Over 10 grand is just, poof, gone on a screen. Meanwhile, look at what's happening to Theo. While Quinn's screen is just bleeding red, Theo's dividend check lands right on schedule. The exact same boring 3-figure deposit he always gets. The entire market might literally be on fire, but the checks guy just got paid anyway, so he barely even looks up from his morning coffee.
So the absolutely crucial point is this. What does Quinn do? Now, on a spreadsheet, if Quinn just sits there and does nothing, the fund will eventually recover. But watching your identity and your net worth drop by a third overnight, that is a 3 a.m. event. It makes human beings panic. It makes us hit the sell button, which permanently locks in a temporary loss. This whole phenomenon actually has a name. It's called the behavior gap. There's this fascinating annual study called Mind the Gap that tracks exactly this. It compares what investment funds actually return over a decade to what the humans holding those funds actually earned. And you guys, the results are brutal. The average investor trails their own funds by about 1.2% a year. Why? Because they get terrified at the bottom and sell, and they get super hopeful at the top and buy. Over 30 years, that tiny 1.2% gap dragged across a $10,000 investment quietly drains $49,000 from your account. And that money wasn't lost to a market crash. It wasn't lost to high management fees either. It was lost completely to the very human act of flinching at the exact wrong moment. Basically, the account leaks the most through the hole labeled you. Let's move along to Act 3, the hidden weaknesses, because honestly, it's not just Quinn's tech bet that has unspoken flaws.
Every single one of these funds has a weakness that the fan clubs love to ignore. Angel's safe S&P 500 market fund, it is secretly packed with the exact same giant tech companies that dominate Quinn's fund. She basically took a slightly smaller tech bet while mistakenly believing she was totally diversified. Quinn's bet fund, as we've already seen, features volatility that absolutely shatters the average human nervous system. And Theo's checks fund, well, he completely missed out on massive upside growth. He traded wealth acceleration just to feel safe, which, if you think about it, is a massive hidden cost all on its own.
Furthermore, underneath all three of these options sits a silent partner that nobody invited to the party: inflation. The historical average return of the stock market is about 10% a year. But once you subtract inflation, your real return, measured in actual purchasing power, gets knocked down to about 7%. Inflation quietly takes its cut from Angel, Quinn, and Theo every single year without fail. And let's not forget fees. Angel's $3 fee and Quinn's $18 fee sound virtually identical today, right? But stretch those over a 30-year timeline, and Quinn's slightly higher 0.18% fee quietly hands over $7,000 more than Angel's microscopic fee. And if any of them had accidentally chosen a standard 1% fee fund, wow, that lazy decision would have cost them $40,000 over the exact same stretch.
Okay, now we enter Act 4, the 30-year illusion. Let's see who actually wins the mathematical race.
If we run the full 30 years, assuming a tempered historical rate and assuming everyone holds perfectly, the numbers look almost cartoonish. Angel's market fund lands near $174,000. Quinn's tech bet climbs toward $300,000. Theo's checks settle around $133,000, plus his decades of dividends. So purely on paper, it looks like Quinn wins in an absolute landslide.
But look really closely at what that massive $300,000 number silently assumes. It assumes Quinn survived every single 35% drop over 30 years without ever flinching or hitting that sell button. The tech bet wins on paper, for sure, but in an actual human life, it is the least likely to survive contact with reality. Why? Because the spreadsheet doesn't have a nervous system. You do.
Which brings us to the twist sitting right in front of us, the fourth option.
Because, there was never a rule that you had to pick just one fund. You can take that $10,000 and just split it equally across all three. 33% in the market, 33% in the bet, and 33% in the checks. What happens? You get the market's solid middle ground, you get the bet's explosive upside, and you have the checks constantly cushioning to falls with actual cash.
By blending these funds, you completely change the psychology of the game. When a crash inevitably arrives, the checks keep paying, the broad market holds the middle, and the overall portfolio drops noticeably less than a pure tech bet would. This makes it dramatically easier to do the single hardest thing in all of investing: absolutely nothing.
You see, the real trap isn't debating Vanguard versus the NASDAQ versus the dividend fund. The real trap is blindly picking just one because of a confident stranger on the internet and then bailing the very instant it starts to hurt. The goal here isn't to hunt down the ultimate ticker symbol. The goal is to build a balanced portfolio that a normal, nervous human being can actually survive owning through the worst week of their financial life. So before you follow the next massive index fund trend, I want you to ask yourself the only question that truly matters. When your portfolio drops 35%, and at some point it absolutely will, are you going to be able to hold, or are you going to become the reason your own investment failed? Pick the fund you want, but make absolutely sure you've picked a plan you can emotionally survive. Thanks for joining me on this explainer, and I'll see you next time.